just want to pick up, Mark, on something that Diana just reported on pending home sales, which can often be seen as a leading indicator. The level at a record low. So worse during the financial crisis and the housing crisis. How bad is it out there for housing?
Bad. The housing market's in a deep freeze when it comes to home sales and origination volume. You got a fixed mortgage rate. I saw Diana's number, 6.8%. The average coupon on an existing mortgage, so you look at all the mortgage debt outstanding, look at the average interest rate, it's 4%. So, think about the economics of that for a homeowner. It just doesn't make any sense to sell your home, extinguish your mortgage at 4%, go buy another home and get a mortgage at 6.8. It just doesn't work economically. So even though inventories are up, they're very, very low by historical standards. And so there's, until we see mortgage rates come in closer to 6 and even into the 5s, I just don't think this market's going to come back to life to any significant degree.
I mean, they should come in a little bit. We've seen a big move in the 10-year yield just in the last few weeks, even in the last week or so. Mark, that could be helpful. We know this administration is looking carefully and targeting the 10-year yield. The Treasury Secretary has said that. What do you ascribe to the lower Treasury yields? Do you think this growth scare is for real?
Yeah, it's real. I don't know how you target the 10-year Treasury yield. Good luck with that. It's got a mind of its own. Global investors determine the 10-year yield. And, of course, mortgage rates are much higher than the 10-year yield because of volatility of interest rates. Interest rates are jumping up and down and all around, and that makes the value of the prepayment option in the mortgage greater, and thus, the rate is much higher. So Sarah, I wouldn't count on the mortgage rate coming in much as a result. But the decline in the 10-year yield and now the inversion of the yield curve again, 10-year yield is, last I looked, below the 3-month and 2-year, is growth. The economy is starting to gag on all the uncertainty that's coming out of policy being made in Washington, D.C., everything from the tariffs to the haphazard cuts to government employment. And we've got the potential for a government shutdown in a couple of weeks. And then, of course, there's the Treasury debt limit. I mean, there's just so much uncertainty. And, of course, that's got the Fed on hold. The Fed's told us point blank they're not going to do anything until they get some clarity around economic policy. And I think businesses and consumers are starting to say the same thing, with all this uncertainty. I may not pull back. I may not cut jobs. I may not cut my spending. But I'm certainly going to be much more cautious in all those things going forward. And it's reflected in the data. One more data point, given today's data. GDP in the first quarter is tracking now close to 1%. So we grew 3% last year almost. In the fourth quarter of last year, we grew over 2% annualized. And now we're tracking 1% in the first quarter. So that gives you a clear sense of the trajectory here.
Yeah. Well, Mark, I have to say, you did warn us. I remember when there was all this excitement after the Trump win about animal spirits and deregulation and taxes. You said the tariff uncertainty could start to weigh. I guess is that the number one economic risk?
I think it's all of the above. I think it's got people nervous, but the tariffs is clearly for business people. I think they're having a hard time with it, right? I mean, it's which countries, how high, which products, over what period of time. And the thing is, these tariff changes aren't done legislatively. This is done by executive order. So it can change in an instant. The president can decide one thing or the other and execute on that. And I think business people see that. I'm a business person. I make investments, and when I think of an investment, it's pretty simple. I open up a spreadsheet. I put in the revenues I expect. I look at the expenses that I'm going to incur. I calculate a return. I compare that to my cost of capital. But every cell in that spreadsheet, you got to fill it in. Otherwise, you can't calculate your return. Yeah. And I think businesses are having a hard time filling in that spreadsheet.
Figuring that out. Yeah, Mark, thank you for joining us. Always good to talk to you. Mark Zandi from Moody's Analytics.